Scott, consumers just not rattled. I mean, I'd like to know more about when the survey data was taken, but UMich does not reflect any of the jitters that we've seen in the past week.
Yeah, Rick was certainly pretty excited about it, but and I mean it's a good number and these retail sales numbers, that was kind of an odd thing when you see that kind of confidence number. What consumers do and what they say are usually two different things, but for us, you have wages rising, obviously a good labor market. We expect continued good things in terms of consumer spending as we look down the road. So we've liked the consumer discretionary sector for a long time. We continue to like it, and I think readings like that should be expected.
Why are you not at all worried about, if not tariff pressure on consumer prices and spending, then, I don't know, liability to the equity market, wealth effects going the wrong way, that kind of thing if this thing lasts?
Well, I do think, for us, we expect some trade positives over time now. This week, I think you have to say that the probability of a great deal or the best possible deal has probably gone down a bit. Consumers are not really seeing prices yet. If we have more tariffs and they last longer, they're going to start to see some of that. So that could dampen some spirits there. But, for us, really, we are expecting some tariff positives over time. There is more uncertainty after the last week or two. But, we're that modest growth, modest inflation environment that we're looking for over the next 12 to 18 months seems to be intact, and we don't really see a lot of reasons to change that outlook right now.
Jeff, where do you stand on the markets right now, especially given the fact that we do have some of these uncertainties around trade and around the goings-on with China?
Similar to what we just heard from Scott, we continue to think no recession comes in 2019, no recession in 2020. Certainly the trade issues may continue to weigh on markets in the short term. Markets may continue to suffer from bouts of schizophrenia, as Trump is certainly a president who negotiates in public. And so the markets have learned from that, but it doesn't dim our sort of longer term outlook of decent growth going forward. And if you were to get a trade resolution, you could see markets move to the upside, but they are going to be volatile, we think, in the near term.
So then, Jeff, would that make something like industrials attractive and some of these other cyclical stocks attractive to you right now, especially when you have a company like Deere coming out and actually cutting its outlook based on the concerns around agriculture and around the impact from China?
So I'm not the person within our firm that makes sort of the individual sector bets, but we are neutral weight to our equity posture, to our overall risk posture for our clients right here. Certainly, we have a well-diversified portfolio within all sectors for our clients, allowing our managers to perhaps buy on weakness if they deem it appropriate. But for us, you have to make sure that the inclination can be when volatility, picks up like this, is to de-risk your portfolio, and we're trying the best we can to keep our clients at their neutral target, trying to have them participate in this market, even though it can be uncomfortable.
Hey, Scott, if consumers are not bothered by all the things we talk about all day, Philly Fed, the 6-month outlook yesterday was near a 2-year low, and that tends to track industrial production over time. So do you think if there is liability to the economy, it comes from CapEx growth or something really defined within manufacturing?
It looks like, Carl, really, we have to continue to rely on the consumer here because CapEx growth, we expect, it to be positive certainly, but not, it's not going to blow away expectations or anything like that because there's just too much uncertainty out there, and you can see it across the globe, whether it's, you just mentioned one of the ag companies there, but also if you look at, for instance, emerging market earnings, if you look at the what's coming out of Taiwan and South Korea, big exporters of high-tech gear into China. I mean, those earnings are down big time, 25, 40% in the first quarter year over year, and it's due to this uncertainty. So uncertainty here in the States, it's uncertainty around the world, and it's going to cut into CapEx spending, and it's going to hold back CapEx spending. So for right now, what we're counting on is incremental improvement in CapEx spending, but really in the U.S. economy anyway, the consumer's going to need to continue to be the horse.
Finally, Jeff, A lot of people watching this dollar trade-weighted index and arguing that a break above these levels or right around near where we are could be relatively destructive. How much of a problem might that be?
No, certainly for large cap stocks, multinational stocks, a higher dollar makes it tougher to do business overseas. We'll have to monitor that closely. If the dollar moves are measured, however, that it seems to be, and companies have a chance to adjust to it. History is okay, but we'll have to watch for sharp upward spikes in currencies, which sort of catch markets off guard and can catch companies off guard. And as they report earnings, they can a lot of times talk about currency having putting downward pressure on profits. Yeah. So we'll continue to monitor that, but if we hold at these levels, we think companies will be able to adjust.